Hey everyone, ready to take your trading to the next level. You guys sent in this awesome list of 20 rules that professional options traders live by. And since this stuff is pretty insightful,
Yeah, definitely. I've got to agree with you there. Some good stuff.
so we're going to break down these rules, see what really makes them tick, and figure out how you can actually use them, in your own trading.
Sounds good.
So we're doing a deep dive today, folks,
Deep dive. Love it.
into these, what do we say, 20 rules? 20 rules for options traders.
20 rules for options traders. And you know what's interesting is a lot of these rules, while they're framed around options trading, they actually apply to just making smart financial decisions in general,
That's a great point.
no matter what you're investing in.
Right, right. So it's not just if you're like a hardcore options trader, everyone can kind of get something out of this.
Exactly.
Okay, but this source doesn't really sugarcoat things either.
Oh, no.
It straight up says almost 90% of traders fail within like 3 years.
Yeah, it's a tough business.
That's a scary thought. What are we doing here to like help our listeners beat those odds?
Yeah, I think that statistic really highlights why approaching trading like a pro is so important, right? It's not about getting lucky. It's about building a solid approach that can actually last. And the source kind of points to two key skills here, which are first, creating a strong strategy, and second, knowing when to adapt as the market changes.
Okay, that makes sense. But how do you know when to like switch things up? What should you be looking for?
Well, that's where these 20 rules come in. They give you kind of specific tools and insights to build that adaptability and discipline that we're talking about. For example, rule #2 is avoid the herd mentality.
Ooh, now that one caught my eye because it almost seems counterintuitive, right? Don't you want to see what everyone else is doing to get a feel for where the market's going?
It's a common thought, but think about it like this. Have you ever seen those concert ticket scalpers outside a venue?
Oh, yeah.
They create this frenzy, right? They make it seem like tickets are super scarce and that drives up the price. And the people who just follow the crowd, they end up overpaying.
Yeah.
The market can be kind of like that too. Sophisticated players can manipulate the herd, and if you're just blindly following, you could end up buying high and selling low.
Wow, I never thought about it that way, but that makes total sense. So it's about thinking for yourself, not just chasing the latest trend.
Exactly, yeah.
Do your own research.
And this idea of independent thinking, it connects directly to rule #5, avoid obvious trades. If something seems like an easy win in the market, it probably is too good to be true. The price, most likely, already reflects that information because, well, the market is actually pretty efficient at processing news.
Okay, hold on. What exactly does market efficiency mean?
Imagine you're trading options on a company, and suddenly news breaks that they've made this huge discovery, right?
Okay. Yeah.
Everyone jumps in to buy call options. They're expecting the price to, like, skyrocket. But because the market is efficient, that good news is already factored into the options price. So by the time you buy in, the potential for big profits might already be gone.
So chasing those like obvious trades might not be so smart after all. Okay, I'm starting to see how these rules are all about like being a step ahead, right? Thinking ahead. Okay, this next one is this is interesting. This is intriguing. Rule #8, leverage both logic and intuition. How can you combine like logic and intuition? Aren't they kind of opposites?
It might seem that way, but think of it like this. Logic is your foundation. It's analyzing charts, financials, all the hard data.
Right.
Intuition is like that gut feeling you get from experience, that sense of whether something feels right or wrong.
Okay. Yeah.
Successful traders find a way to kind of blend the two.
So you use logic to inform your decisions, but you also listen to that little voice in the back of your head.
Exactly. I once ignored my intuition, and I really regretted it. I was looking at this options trade, and all the numbers, it seemed perfect. But I had this, like, nagging feeling, something was off. I brushed it aside. I was thinking I was being irrational, and I went ahead with the trade. It was a disaster.
Ouch. That's a good reminder to pay attention to those gut feelings. Sometimes they're picking up on things our logical mind hasn't caught up to yet. Okay, let's move on to rule #16, shift away from a paycheck mentality. What's so important about that?
This rule speaks to the mental game of trading, which I think is often overlooked. Unlike a regular job with a steady paycheck, trading incomes can be unpredictable. You might have some big wins, then nothing for a while. This can be tough for people used to a consistent income. And that unpredictability, it's a big reason, I think, why so many traders fail. They come in expecting quick riches, consistent wins, but the market just doesn't work like that.
Yeah, it definitely has a mind of its own, that's for sure. So you need to be mentally prepared for those ups and downs.
Exactly. Yeah. You got to be patient. You got to ride out those storms, trusting that your strategy will work over the long haul. And that kind of brings us to rule #19, which is accept losses and move on.
Ooh, now that's a tough one. No one likes losing money, but it sounds like the source is saying, like, losses are just part of the game.
It's true. Yeah, losses are inevitable, especially in options trading. Even if you're right about the direction of the underlying asset, factors like time decay can work against you. Let's say, for example, you buy a call option, betting that the stock price will go up. But the price doesn't rise quickly enough. The value of your option can actually erode as it gets closer to its expiration date.
Ah, so even if you get the direction right, you can still lose money if the timing is off. That makes the ability to, like, cut your losses even more important, right?
You got it. That's exactly right. The key is to view losses not as failures, but as learning opportunities. Figure out what went wrong, adjust your approach, and don't dwell on it. Avoid what's called revenge trading, which is where you try to make up for a loss with a risky trade, and then you just end up losing even more.
Yeah, I've definitely been down that road before. Not a fun place to be. So it's best to step back, like really figure out what happened, and then move on. Something that really jumped out at me from this source was the nation of loss aversion and recency bias. Those almost sound more like psychology terms than trading terms.
Yeah, you're right. And that's, I think, what makes this source so insightful. It recognizes that trading isn't just about numbers and charts. It's about understanding human behavior, both your own and that of the market as a whole.
Oh, that's a great point. Okay, so can you break down what those biases mean for someone who's not like a psychology expert? How do they actually affect our trading?
Sure. So let's start with loss aversion. Loss aversion is that human tendency to feel the pain of a loss more intensely than the pleasure of an equal gain. Think about it this way. Losing $100 feels way worse than the joy of gaining $100.
That's so true. So even if you have a good strategy, your emotions can still sabotage you?
They absolutely can, yeah. You might hold on to losing trades too long, hoping they'll turn around, or maybe you sell winners too early because you're scared of losing those profits. It's like cutting a flower bud off before it has a chance to bloom because you're afraid a bug might eat it.
That's a great analogy. I like that. So what about recency bias? How does that play out in trading?
So recency bias is where we tend to give more weight to recent events. Like say you've had a string of winning trades, right? You might get overconfident and take bigger risks than your strategy allows, thinking your winning streak will just last forever. But on the flip side, a few losses in a row, and you might become overly cautious, causing you to miss good opportunities because you're too afraid to jump back in.
It's like those biases are working against us even if we don't realize it. What can we do to like fight back against them?
Well, awareness is the first step. Just knowing these biases exist can help you spot them in your own trading, and then you can start building strategies to counteract them. Having a predefined trading plan with like clear entry and exit points is really, really crucial. It takes some of the emotion out of the decision making. Your plan might say something like, if the price hits this level, I'm out, even if I'm feeling hopeful.
Right. So you're not letting your feelings dictate your actions. You're sticking to the plan.
Exactly. It's like having a set of rules for a board game. You follow the rules, even if you're behind, because, those rules are designed to help you win in the long run. Another helpful tactic is documenting your trades, both the wins and the losses. And then just look for patterns in your behavior. Are you consistently exiting trades too early? Are you holding on to losing trades too long? That self-awareness, I think, is key to improvement.
It's fascinating how much of this comes back to psychology. It's like trading is just as much about mastering your mind as it is about like mastering the market itself.
Couldn't agree more, yeah. The source even says, and I quote, trading tools don't replace skill. You can have all the fancy software and algorithms in the world, but without discipline, emotional control, and critical thinking, well, you're unlikely to succeed.
That's a good point. You can have the best tools, but if you don't know how to use them effectively, they're not going to do you much good.
Exactly. And that brings us back to the importance of thinking independently, which is rule #14. Don't just blindly follow the crowd or try to copy someone else's style. Figure out what works for you, what your strengths are, and develop your own unique approach. It's like finding your own voice in the market, your own way of navigating the chaos.
I love that. Finding your own voice, your own way of navigating the chaos. Now, what about rule #15? Dismiss the idea of a holy grail. I'm curious about what the source meant by that.
Well, it's a reminder that, there's no magic formula that guarantees success in trading. If there were, everyone would be rich, right?
Right, right.
Trading is a constant process of adaptation, learning, and refinement.
So there are no shortcuts. Got it. Okay. I'm struggling a bit with rule #17, secure profits early. How do you balance that with the advice to, let your winners run?
That's a question that many traders grapple with. It's a delicate balance, for sure. Yes, you want to let those winning trades ride as long as the trend is in your favor, but you also need to protect those profits. The market can shift quickly, and unrealized gains can disappear just as fast as they appeared.
So it's like choosing between like the certainty of smaller profits now versus the possibility of bigger profits later. I see the dilemma. What are some ways that traders can manage this?
There are techniques like trailing stops, scaling out of positions, or taking partial profits that experienced traders use to kind of manage this tension.
Okay, yeah, I'll have to look into those. Out of all the rules, which one really stands out to you?
Rule #18 really resonates with me. Simplicity wins. It's so tempting to overcomplicate things in trading, getting lost in complex indicators and strategies, but often the simplest approach is the most effective.
So focusing on like the core fundamentals, like price action and volume.
Exactly. Don't get bogged down trying to analyze every little detail or predict every market move. Keep it simple.
Great advice. It's easy to get overwhelmed by all the information out there. Sometimes, yeah, less is more. We keep coming back to this idea of the importance of accepting losses, which is rule #19. It's such a crucial part of the mental game. What's your take on this?
Well, I think, losses are inevitable, but it's how you handle them that separates successful traders from the rest. It's about viewing those losses as feedback, not as personal failures.
And remembering to avoid that revenge trading mentality, right? Where you try to chase your losses and end up in an even deeper hole.
Precisely. When you experience a loss, take a step back, analyze what happened, adjust your strategy if needed, and then move on with a clear head. Don't let those losses define you or dictate your future actions.
It's amazing how much emphasis these rules place on the psychological aspects of trading. It's almost like a self-help guide for traders. Which brings us to the last rule, rule #20. Avoid trading for the rush.
That's a powerful one. Trading could be, it could be very stimulating. The constant market movements, the potential for big wins, the adrenaline of making a trade, it can be addictive. But if you're mainly trading for that excitement, for the thrill of it, you're setting yourself up for trouble.
It's like gambling then, right?
It can be, yeah, if you're not careful. Successful traders, they're driven by the goal of growing their wealth over time. They understand that it's a business, and they approach it with professionalism, discipline, and emotional control.
So it's about having the right motivation, approaching it as a business rather than a gamble.
Exactly. It's like the difference between someone who plays poker for fun and someone who plays it professionally. The professional is in it to win, not just for the thrill of the game.
We've gone through all these 20 rules, and it's clear they're not just about like specific techniques. They're about developing the right mindset for success.
Yeah, they provide a framework for thinking about trading more strategically and more professionally.
It's been an insightful deep dive, but I feel like we've only scratched the surface here.
You're absolutely right. There's so much wisdom packed into these rules, and they can be applied in so many different ways.
As we've been talking about these 20 rules, I keep coming back to this idea of like professionalism in trading. It's not just about knowing the ins and outs of options. It's about approaching the market with a certain mindset, a certain way of thinking.
Yeah, I totally agree. The source really draws a clear distinction between amateur traders and, professional traders.
Okay, so how can they make that shift? How can they start thinking and acting more like a pro?
Well, I think we've touched on a lot of the key principles already, right? Creating a robust strategy, adapting to changing market cycles, managing risk, understanding those kind of sneaky behavioral biases that we talked about, and cultivating that all-important trader's mindset. But perhaps the most important piece of advice is this: take trading seriously.
So don't just like dabble in it on the side like with your extra cash.
Exactly. If you're serious about succeeding in the market, you really need to invest the time and effort to educate yourself, develop your skills, build a solid foundation. It requires dedication, discipline, and a willingness to continuously learn and improve. It's not a get-rich-quick scheme.
This source really emphasizes the importance of that continuous learning, right? It's not about finding the holy grail of trading, like we said earlier. It's about constantly refining your approach and adapting to the ever-changing market.
Absolutely. The market is a dynamic, fluid, unpredictable beast. What works today might not work tomorrow, right? So you need to be constantly reading, researching, analyzing, testing new ideas.
It sounds like being a lifelong student of the market is a key part of success.
It really is, and that's, I think, what makes trading so fascinating. It's a constant challenge, a constant opportunity for growth and learning. And, the more you learn, the better equipped you'll be to navigate the complexities of the market and achieve your financial goals.
This has been such an eye-opening deep dive. We've covered so much ground from like specific trading rules to broader principles of financial decision making, and of course the psychology of trading, which I think is so important. What's the one key takeaway you hope our listener will walk away with today?
I mean, the source really, it puts a lot of emphasis on developing your own, like, unique trading approach. So my question for our listener is this: what are your strengths, and how can you leverage those strengths in the market? Perhaps you have a knack for technical analysis, or maybe you have a deep understanding of a particular industry, or maybe you have an exceptional ability to manage risk. Whatever those strengths are, identify them, hone those skills, and build a trading approach that plays to your unique abilities.
That's such great advice. It's not about trying to be someone else. It's about finding your own edge, your own unique edge in the market.
Exactly. And that's, I think, ultimately what separates the successful traders from the rest. It's not about following a set of rules blindly. It's about understanding the underlying principles, adapting them to your own personal circumstances, and creating a trading approach that reflects your individual strengths and, of course, your individual goals.
Well said. I think that's a perfect note to end on. To our listener, we encourage you to reflect on what really resonated with you from this deep dive. Which rules spoke to you? What insights can you apply to your own trading journey? Remember, trading is a journey of continuous learning and growth. Embrace the challenges, stay disciplined, and never stop seeking knowledge. Happy trading, everyone!